It's been about a year since the FSA started talking about stress testing in the banks now. You guys have been looking at this issue and done some work in reviewing the area. Jeff, can you put it into sort of context of how the banks have reacted over that year and where they're going with this?
Well, the banks have really looked at it three ways. One set of banks have looked at it and said this is something that is not really relevant to what we do. We're doing it purely because of the regulators. The second set of banks have just said that's exactly what we do. And the third set of banks have actually found some weaknesses within their framework, and they've used it as a tool to enhance their stress testing capabilities.
So looking on the positive side of those two, the ones that are saying we're already doing it and the ones that are saying we can move on and do even better things, have they actually reached the implementation phase of their projects and budgets being allocated to this now?
We've actually seen a significant increase in customers coming to us and asking us to do some custom work around particularly stress testing and risk management per se. We've also seen an increase in demand generally out there in the market. I think one aspect of that is the fact that, you know, with this white paper that we've put out, the response has been quite dramatic. You know, over 350 individuals responded. So that alone tells you there's great interest in the subject matter.
Mm-hmm. So this appetite that there is there, it's not just a knee-jerk tick the box, the FSA want us to do this. You implied there, Jeff, that some people have actually taken it and gone on to a bit more than the historic aspect of it and looked at it in a wider context.
Absolutely. In the past, people have just taken past scenarios. They've run those and they said, tick, we've actually done the stress testing. But now they're looking at more innovative ones, particularly contra-type ones. For example, saying that with the economy improving, we don't look at oil prices going up, which is what normally happens. What happens if they go down? So they're trying to be more innovative, more contra in the types of stress testing that they do.
So people are trying to imagine the worst, feed that in, and hopefully come up with a truer picture of what potentially could happen.
Absolutely.
But moving that from the theoretical level, from a systems point of view, from an implementation point of view, that spreads it out a lot more within the organisation, doesn't it?
It certainly does, and typically the financial institutions have operated as silos. The interest rate derivative silo, the treasury silo, the equities silo. And within that context, you've actually got to have stress testing across the board for the regulator. So it's got to be across all the silos that are in existence. That creates an awful lot of problems for systems and interfacing systems and collecting the data across all assets in order to report back to the regulators. So in effect, what we're seeing is that companies are looking more towards having a single solution approach where you can cover all the assets in one solution, and you can do that throughout the life cycle of the trade.
But that means getting a fairly high level buy-in from the senior management within the institution, doesn't it? So there's a big commitment involved here.
It does indeed, and you tend to see variation between the different types of banking institutions out there. So for example, the very large institutions, the tier 1 institutions, will continue to operate in silos because of the issues of handling the volumes alone, you know, as one issue. But tier 2 and tier 3 institutions, I think, are very well set, especially if they're looking to move away from just treasury and capital markets operations into, say, trading commodities or energy. If they're doing that, then ideally having a holistic solution across all assets, one platform, that's ideally what they should be looking to implement.
And Jeff, when you were researching for the white paper, did you see that level of commitment coming through from the institutions, the buy-in?
Absolutely. I mean, previously the standard for looking at risk was VAR, and VAR is a good number to give you a kind of general level, but stress testing is actually defined in its name. It's looking at all the stresses that can bring a bank down, as we've seen in the marketplace. And I think going forward that stress testing will continue to be the key factor that people are looking at.
You don't see it being as a transitory and slightly discredited measure like VAR?
Absolutely not.
Okay. And this is going to be an ongoing part of the day-to-day existence of institutions?
I think it has to. I think certainly the regulators are going to continue to enforce the kind of regulation that we've seen over the last year alone, and there's a whole raft of additional regulation coming out next year. and the banks have got to be prepared to address, for example, just on liquidity, address the requirements of the FSA on liquidity. I think the other thing is that in the past you've had risk management techniques being widely used, market risk and credit risk, and those numbers are being reported up to management and being reported to the regulators. So what's changed? Actually, nothing really has changed that dramatically, apart from the fact that we've had a financial crisis. Now what I think we will see is that the risk management and the stress testing becomes an integrated part of the decision-making process, and it should be. Dictating the strategy of the institution as opposed to just being a mere reporting tool to satisfy management practices.
Thank you very much.